Brown and welcome to this week's MFB news. I hope everybody is doing really well and you all had an absolutely super bank holiday weekend. It didn't rain, admittedly it wasn't crazy hot either, but I think an August bank holiday in the UK, the fact the weather was relatively dry is something to be grateful for. This week we have got lots of changes from lenders, some criteria enhancements and also some repricing to run through with you. I'm also going to just then give you a little bit of an overview in terms of the housing market and the types of properties which are seeing a much larger increase in asking price, sale price than their counterparts. So lots of great stuff to cover off today. Okay, so first up this week we have some pricing reductions from our friends over at Keystone Property Finance. They brought some pricing down. The rates now start from 2.79% on their green mortgage range and 2.89% on their standard range. Now Keystone are certainly a specialist lender. They're very prolific in that end of the market. They can lend to limited companies and individuals. For their limited company offering, it's very strong. They would accept layered companies and trading companies as well as standard SPVs. They don't mind how many properties you have in the background. There's a no minimum income requirement policy in place. They can accept day one remortgages. Now look, in terms of the types of tenancies, I think this is one of the things they're very good at. They are able to accept DSS tenants, corporate lets, and also if you're letting the property to housing associations as well. Now Keystone are also looking to lend on not just standard properties, and their appetite on standard properties extends to things like studio flats, but they're also able to lend on HMOs of up to 10 bedrooms and multi-units of up to 10 self-contained units as well. And they're also able to consider lending to expats. So a really super broad lending policy there with some rate reductions this week. West One have made some changes to their pricing in the last week. So their pricing has come down and now starts from 3.04%. So look, who are West One looking to lend to? So again, another specialist lender, no minimum income, no maximum number of properties in the background, can lend to limited companies as well as individuals. They're able to consider HMOs and multi-units of up to 6 rooms or units. They can actually go to 10 as well by referral. Now I think in terms of West One and who they are as a lender, the things that I particularly, where I feel they're quite strong is their ability to lend on slightly more unusual property types. So they can consider ex-local authority flats, ex-local authority houses, studio flats as long as they're greater than 30 square metres in size, flying freeholds, properties with relatively short leases. They need 55 years left on the lease at the end of the mortgage term. So if you had essentially the minimum lease they could consider is 61 years because there's a minimum of 5-year term on any of their mortgages. They can also consider listed buildings as long as it's not grade 1 and new builds. So lots of great things in terms of the properties that they can consider, as well as being able to lend on to our very sort of our larger landlords and also the HMOs and multi-units. Now what they've also done is made some pricing reductions on their short-term let product. Now the short-term let product is essentially one which is available for people who are letting properties on holiday lets and also Airbnb. So great to see that come down a bit. I think in terms of the holiday let market generally and the pricing there, things are certainly coming down on a relatively regular basis, and I think there probably is a little bit more room to come or room for manoeuvre there. They've also made some reductions on their expat pricing, so their rates on those now start from 3.84% as well. So some really great changes from West One in the last week. Now, to make sure we're balanced in what we're telling you, it's important that we tell you about the not so great news as well as the great news. So Vida Home Loans in the last week have removed a whole bunch of their limited edition products. Now, limited edition products is when a lender will release, generally speaking, a very attractive deal, which is available on a kind of, it's a limited basis. So essentially we have X amount of millions of pounds to lend on this rate, and when the money has gone, it's gone and there's no more. But what Vida have found is they've been absolutely bombarded with new business applications. Vida as a lender lend on homeowner mortgages and investment mortgages, and across the piece they've been bombarded by new applications. So they've taken a very strategic decision to withdraw some of those very good rates which were really driving up their business levels, to slow things down and put forward them the opportunity to get back on top of things. So look, it's a shame that we're losing out on those rates, but I think really, it's Vida to be saluted for doing this. They have had a slightly unfortunate history in the last 12 months with regards to their service, so I'm really pleased is that they've learned from their mistakes and they're doing this, removing those very attractive products that slows things down and they can get back on top of their service levels. They haven't announced a reintroduction of the new rates just now, but we'll be watching this space for Vida's new pricing as it comes out. We'll keep you posted. Aldermore have now re-entered the HMO and multi-unit market, introducing, or reintroducing I should say, a product range for HMOs of up to 6 bedrooms and multi-units of up to 6 self-contained units, and their pricing now starts from 3.68%. Now these are available to existing landlords who need to have at least 12 months worth of letting experience under their belt before they will consider offering these to them. They're available to individuals and limited companies, and I should add here that Aldermore are able to consider trading companies as well as SPVs. They don't mind how many properties you've got in the background. There's a minimum property value of £75,000. Now in addition to this, they've also gone into the 80% loan to value market. Their pricing here starts from 3.88%. Now I'm sharing this with you not because the offering is exceptional by any stretch of the imagination. There are HMO rates and multi-unit rates and also higher 80% loan to value products which are lower than these. But the reason I think this is really important to share with you is it really shows where the market is and what's going on at the moment. We talk often about the fact that the lenders had a fairly busy period in the autumn of last year. Business was flowing in through the door, so they weren't under a huge amount of pressure to necessarily review their lending criteria and consider maybe scaling back up some of the cuts that they made at the start of COVID. But now what we're finding is the applications have really slowed down and the lenders are really taking time to go back, have a look at their offering and see where they can make adjustments to really kind of improve their offering to people. And clearly, you know, this is exactly what Aldermore have done here, which is really good news. A few other changes just to run through briefly with you this week. So first of all, NatWest have made reductions on their pricing of up to 14 basis points, with rates now starting from 1.38%. Foundation Home Loans have made reductions of up to 20 basis points across their product range. So their pricing now starts from 2.89%. They've also introduced a new holiday let product with fixed arrangement fees as well. And keeping on the theme of holiday letting, the Furness have also launched some new buy-to-let and holiday let rates. Now the holiday let rates, which I think is where the Furness are particularly strong, start from 2.19%. Now in terms of them as a lender, they're very, very good at the holiday let offering, I have to say. Some things that they offer which are quite unique. They do allow personal use of the property for up to 90 days in the year. They can consider interest only or repayment. They're available to up to 75% loan to value. They're available on only the mainland of the UK though, so just to keep that in mind. But yeah, look, so some more repricing from lenders downwards and the theme just really continues. Now lastly on our lender updates this week, Accord Mortgages have announced a change which I really thought was worth just bringing into the mix with you because it really kind of throws up an area which is, we don't talk about it often actually, and it's relatively complicated and actually very, very relevant, and it's all about when you're borrowing in your personal name, the rental calculation lenders would use to lend to you and the tax threshold that you fall into and how that impacts which calculation the lender will use. So to explain that a little bit better than I think I have done, when you're borrowing through your personal name, lender's default calculation tends to be something along the lines of 145% coverage, assuming an interest rate of 5.5%. And I'm talking very generally here, there are variations on this. Now what some lenders say is actually, if you can demonstrate that you are a basic rate taxpayer, we don't use the 145% calculation, we use a 125% calculation, because these guys who aren't paying as much tax will obviously have more rental income left over to build a surplus, therefore they can withstand a sort of slightly more generous calculation. Now the thing that comes into question here is actually what constitutes you being a higher rate taxpayer. So for example, some lenders, what they do is they will take all of your earned income, add on your gross rental income, and if this pushes you, this gross number, over a certain figure, and it tends to be about £45,000 at the moment, it does vary from lender to lender, they will treat you as a higher rate taxpayer, and therefore you will be subject to the more onerous calculation, of 145% coverage. Now what Accord Mortgages have done is looked at their kind of criteria here, They're saying that actually we're not going to use a threshold of £45,000. We're going to increase this to 50,271 if you're in England and Wales, or 43,663 if you're in Scotland. So actually for those people who maybe were £45,000 a year income, 145% coverage, this might benefit you actually and allow you to slip into that lower rental calculation. Now additionally, it's worth pointing out here that Accord are working on tax return income, so rental declared profit, rather than turnover. So each lender is different. So if you are looking at a buy-to-let mortgage in your personal name and you're being classed as a high rate taxpayer, but your income levels sit at around the £40,000 to £50,000 mark, it's really worth kind of probing this a little bit further to see whether by picking the right lender, actually you can benefit from that more generous rental calculation. Now I was reading an article the other day which I just found really interesting and wanted to share with you, which was from the site Zoopla, which said that data from property listings has shown that the average price of a family home, so a house, rose by 7.6% from January to July this year. Whereas for flats, this was a much more modest 1.2%. So when we're hearing about house price growth going up across the UK, actually, what this really tells us is that this is much more granular, depending on which kind of property, which property type you're actually looking at here, which I thought was really interesting. And also really worth considering if you are thinking about investing, particularly over the coming year. Now, what they also said is that the speed of sales has increased massively, with the average time from listing to sale subject to contract at 26 days, which is down from 49 days in 2019. They also went on to say that they expect the average price growth to settle at between 4 or 5% by the end of this year. And this actually is a sentiment that we're seeing echoed across the industry by various industry figures, spokespeople, specialists, that really the expectation is that house price growth is going to be very much in the positive, and it's going to be sitting at around, like I say, the 4 to 5% figure. Now, just touching on the kind of backdrop to all of this, so what they have said is that the overall price increase of 6% was driven in large part by the lack of stock, in particular a dearth of family homes on the market, as a reassessment of home owing to the pandemic saw borrowers want more space. The total stock for sale was 26% lower this year compared to the end of July 2020, and levels were expected to remain depressed well into next year. On the demand side, the picture was one of growth running at 21%. So essentially what we're seeing here is that actually the number of people who are still looking to buy properties, are looking, has increased, but the number of houses that are available on the market are very, very low. And actually now I've even witnessed this firsthand. I mentioned a couple of weeks ago we're looking to move house, and we have just found there has been very, very little stock coming to market. Fortuitously, a house came on the market that we were interested in. We then subsequently put our house on the market. Our house is a very sort of standard family home, and our house went under offer within a matter of a few days. So it just goes to really demonstrate that this is playing out in real life as well. But I think realistically, what we're seeing here is actually that there will be a continued growth in house prices. The balance between supply and demand is absolutely not right yet, which is going to drive things up. And actually one final comment from the report that I read, which I found really interesting, was that demand from buy-to-let investors grew by 21% in the year to the end of July compared to the same period last year. So actually, I think what's happening is a lot of our landlord clients are also looking at the market, recognising that things are going to continue to go up, and actually it's much better to lock in an investment at today's prices than maybe in a year's time when they're 5% higher. That is everything for this week, folks. Thank you, as always, for joining us. For those of you who have children returning to school in the next few days, I wish them all the best of luck, particularly those going to new schools. My son's return to school has been delayed by a couple of days because the school only seem to have just realised that they're going to have to do some COVID testing. So we've managed to extend the school holiday by another 2 days, which is great news for my son. If you do need to have a chat with us, we would love to hear from you as always. 0345 345 6788, or have a look at our website, which is absolutely jam-packed with loads of great information. I'll be back again this time next week, so until then, do look after yourselves, and I'll catch you next time.